The Nasdaq is down a tremendous 11% in just the last couple of days. Now, some might be asking, is this the end and should I close all of my stock positions? Well, the situation might not be that dire, but there are some serious concerns that caused this decline. Now, what these concerns are, how we are developing our investment strategy, and how you might want to as well, even if you're just broadly investing into ETFs like the MSCI World, right after the intro. Hello and welcome to another video here at Bloomberg Capital. My name is Henrik and let's get right into it and not waste any more time. So let's answer the question, why is the price falling at the moment? And a big keyword here is uncertainty in the American market, which is not a very good basis for investment. But where is all of this uncertainty coming from? One major factor certainly is the current tariff policies enacted by Donald Trump. Now, in February, he announced a lot of new tariffs coming in March, especially for countries like Canada and Mexico, which many people just assumed to be bargaining chips. But as a lot of these bargains were struck, it became more and more clear that these tariffs were here to stay. Now, the market didn't really like these news. There was a lot of negative feedback from everywhere, and even from people like the CEO of Ford, who said that especially the automotive industry would be very negatively impacted by this. This is because in a relatively tariff-free environment, a lot of companies actually set up their production chains across borders, especially between countries like the US and Mexico. Here, certain parts are actually crossing the border several times in a single production cycle. So as it stands, with the planned tariffs, the entire automotive industry would be hit very, very hard. Now, with all of this negative feedback from everyday people as well as big financial figures, these tariffs were actually postponed into the future. But overall, there were a lot of different decisions back and forth, whether these tariffs were coming, not coming, postponed till when, and so on. This just in general leaves a lot of companies with a lack of a planning basis, as they do not know if these tariffs are coming, in what form they are coming, and when they are coming. So nobody really knows how the situation will really be looking even just next month, which obviously causes a lot of uncertainty. Now, it is relatively certain that a potential trade war is not really something that most companies would want. But even for the general populace, it will likely mean a lot of inflation, as a lot of products will just get more expensive. And similarly, policy ideas were floated around, like, for example, the potential refund checks by Doge that would come from savings and government spending won't really do a lot to curb inflation either. And even further than that, the growing animosity between long-standing partners, like for example the US and Canada now, that is growing because of these potential tariffs, might not be playing out in the US's favor in the long term. Because Canada, for example, has decided to not give any more state contracts to American firms. But there are also a lot more anti-American movements growing around the world. So for example, in Canada, it would be Buy Canadian, which is a movement that primarily aims to get people to buy Canadian wares, but also, especially, not buy American wares. Similarly, in Europe, sales of companies like Tesla have plummeted hard. But now that we looked at why price fell and why it might continue to struggle, at least for a little bit, what does that really tell me as an investor? Because while some investors might be concerned, others might just see it as a good opportunity to stock up on some ETF positions. Because while some investors might be concerned, and rightly so, others might just see it as a good opportunity to stock up on some ETF positions like, for example, the Nasdaq, the S&P, or the MSCI World. But we are currently seeing a development that has not happened a lot in the history of the American economy. We are seeing money actively leaving the country. So while prices might rebound a bit from here, they will probably struggle to outperform the rest of the world economy as they have done for the past decades, at least for a bit. So you might want to look into other opportunities than just the American market. And here, options like the MSCI World aren't really as diversified as you might think. If we look at the makeup of the MSCI World, we are seeing that it's actually primarily just invested in the US market, a bit more than 73% to be exact. Even more shockingly is that more than 40% of that already big chunk is invested in just 10 big companies. So this is not as diversified as a lot of people might expect it to be. And if you're investing in the MSCI World, you need to know that you're primarily investing in the US market, which is why it saw a similar decline as the US stocks in the last few days. Now, the reason why it is out of proportion is because American stocks, especially the big ones, have outperformed the overall market by quite a bit for the last few decades. But as we are entering what we think is a time where some other countries might catch up a bit, this might not be the best place to park at least all of your money. The MSCI World is in no means a bad investment, but maybe you should look into some other ETFs of other countries to balance everything out. To look at which countries you might want to pick, you just have to look at where the money is going that is leaving the US. The biggest winner here, at least at the moment, is Germany, which in the MSCI World here is only represented by a bit over 2% of the allocation. But let's not get ahead of ourselves here and look what is actually making the German economy so interesting after years of stagnation. Now, one thing to consider when looking at these gains is that investors here aren't really looking too much into how it is looking right now, but more the potential that they see for the country. For one, the new German government is pushing for big new reforms to finally invest in the country after many years of not doing so. So we have the new special investment fund for infrastructure of about 500 billion euros, as well as a lot of extra funds for defense. This comes after a long time with the German debt ceiling that is only in effect in theory anymore after all these new special funds that are about to be granted. Now, you might argue about the negative effects of taking on debt for investments like these, but it is undeniable that at least for now, this will mean an economic boost for Germany. This piqued the interest of a lot of investors that, with their money coming in, are only strengthening this effect. With a lot of investors specifically coming in from foreign countries like the US, the euro is also gaining in strength, as a lot of investors are buying euros to invest them there. This is only further compounding these gains, as investors are also raking in these currency gains. Now, on the other hand, Germany, as an export-focused nation, will likely also feel the effects of a potential trade war with the US, especially the already struggling automotive industry. But as Germany has a lot of other strong trading partners, especially within the European Union, most other branches of the economy should not be hit too hard and should actually be doing pretty good in the weeks and months to come. So, Germany is a country with a lot of potential, and most importantly, it is more stable than the US, at least at the moment, giving investors more certainty and a better chance to plan their investments. But what can you do as an investor right now? To answer that question, let's take another closer look at the German stock index. Here, the German stock index has been performing really well in the last few years. To be exact, we saw an almost doubling of the price here in the last about 2.5 years. But what will price likely do in the short term? We are actually seeing the potential for a short-term top and a bit of a sideways phase here after the recent hype, where price will build a base to push higher from. So there's really no reason to panic here. You do have enough time to buy in at a better price soon. The sideways phase here can take about the next 1 to 3 months. Now, for the Nasdaq, we are seeing a similar thing, but in reverse. So we saw a lot of bearish price action, especially in the last few weeks. But now we're seeing potential for a bit of a recovery happening here to take prices a bit higher. So here, the same thing. No reason to panic, to sell all of your stock positions. You do have time to wait for a recovery. And maybe even if you're interested in short-term swing trading, you might even consider buying in here to take some profits. But after this recovery phase, in both stock indexes, so the Nasdaq and the American market as a whole, as well as the sideways phase to build a base in the German stock index, we will likely see the German stock index outperforming the American market. So if you are primarily or solely invested in the American market, you might consider moving a bit of money over, not right now, as hype and interest in this is the biggest, but in a few weeks, when things have calmed down a bit and are ready to really get going. If you're interested in the timing when we will move over some of our positions, you can join our Discord, where we give you a closer look into our analysis as well as portfolio management. And with that, I wish you a good week, and until next time, here at Bloomberg Capital.